let's move on to my main focus point, which concerns this headline. Tariff fallout. Bond yields plummet as investors seek safety. Now, if you're paying attention to the bond market, I know the equity market is more exciting for people, but in reality, I think bonds are more important. And typically when you have drawdowns, when you have crashes, which is what this was, what you see is investors fleeing risk assets for risk-off assets, the safest of which historically has been U.S. Treasuries. And so that's kind of what you saw on Thursday, right? You saw the 10-year yield falling a little bit. It briefly, at one point last week, dipped below 4, but that's not really where it is anymore, right? The 10-year bond right now, 10-year, finished above 4, I think around 4.15 today is where it was trading last when I looked at it. You had TLT, which is the long-term treasury ETF, iShares long-term treasury ETF, 20-plus year treasury bond ETF, was negative on the day. And so what this tells me, coupled with the fact that the dollar is, which should be getting stronger, right? People tend to have the demand for dollar-denominated bonds and then seek dollars. In past crises, dollar's stronger. Past 3 days, that really hasn't been the case. And so what does all of this mean, right? This isn't just unique to the US. Japan's 10-year yield hit a 3-month low at one point. That started to taper off. Why are yields rising when volatility is spiking? And the answer could be one of a couple things, both of which probably don't signal anything good for the US economy. One is investors are angry and do not want US assets. They don't feel as though the two most important things about the US economy, stability and the dollar. Those are our two main exports to the world. And so instability and uncertainty means that what people used to think as a risk-free asset could move more and more away from that standing. That's number one. Number two, inflation expectations. If costs are going up, if consumers are spending less, if incomes are going down, right? Overall incomes, and by that I mean the tax base, because companies are paring back. If unemployment goes up, there's less revenue for the government, there's higher costs. That means more debt financing. That means higher rates. And so the market could be telling us right now, the bond market, that although there are people out there saying this is all done on purpose to lower yields, I don't buy that in the first place. It's also not happening anymore. Yields are starting to rise. And so although most people pay attention to equities, when the bond market speaks, you have to listen. And so when I heard yesterday that the market's pricing in 120 basis points of cuts, I don't buy that. Bond market's not buying that. Powell's saying that's not going to happen. There was caution on Thursday saying the bond rally didn't last, and that certainly seemed to be the case. And so for now, given what is happening, April 9th, the next key date, more tariffs are set to hit. I'm watching, the market's watching, the Fed's watching. Who's going to blink? The Fed or the bond market? Last time they priced in 7 cuts in a year, they were wrong. Right now they're pricing in 100 basis points. I think they're wrong again.